Hello to everyone. Welcome you to Legacy Wednesdays, where every Wednesday we bring you an educational webinar on how to be a smarter investor, how to be a savvy investor. We're going to discuss a little bit. We're going to talk about FIRE, which is Financial Independence, Retire Early. But before we get started on that, today's topic is how to escape the 9 to 5 and how IT professionals in particular can create streams of passive income through real estate. So if you're listening to this and you're an IT professional, make sure you pay close attention. This webinar was exclusively designed for you and how you can get started investing in commercial real estate as a passive investor. So let's go ahead and dive right in. As mentioned, before we get started today, let's go through the index. We'll talk today about sources of passive income, talk about some strategies, and then we'll talk about your pathway and how you can leave the 9 to 5 and achieve that lifestyle freedom that you're so looking for. And then we'll cover a couple of investing options we have open as well. Just a quick disclaimer before we dive into the nitty gritty here. Obviously, this webinar is for educational purposes only. It's not any type of legal advice or investment advice. It's also no guarantee of performance or return. We always advise all of our investing partners to consult with their attorney, their CPA, or their financial advisors if they have any specific questions and related to their situation before they make any type of investment. All right. So let's talk a little bit about Financial Independence, Retire Early. So what is FIRE? What does that stand for? If you haven't heard that acronym before, FIRE stands for Financial Independence, Retire Early. So these are for people that are looking to achieve financial independence by either lots of cash flow, or buying businesses, or buying real estate so they can retire early. So this webinar that we host every Wednesday at 12 p.m. Pacific, 2 p.m. Central, 3 p.m. Eastern is designed for those looking for financial independence. They want to retire early. So this is for you. Let's talk a little bit about Headway and who we are. If you don't know who we are and you're new to the webinar here, first of all, I want to welcome you again. Just to give you a quick background on Headway Capital, and who we are and what we're here for. Our company was designed to build and protect the wealth of busy professionals. So we provide private investment opportunities that give you the freedom to do what matters most. And that's by achieving that passive income, by achieving that cash flow. Our team has been investing in real estate since 2011. And we have experience sourcing, vetting, and investing in all types of alternative investments through different market cycles as well. So we have multifamily experience. Sid and I both were residential real estate investors on the single family side before, have experience in industrial. We have car washes in our portfolio. We like touching assets that cash flow. So we have different types of experience and different backgrounds. I'll talk about myself real quick, and then I'll definitely hand the mic over to Sid to talk about him and his wife, Anam. As mentioned, my name's Brian. I'm the Director of Investor Relations here at Headway Capital. Quick background about me. I got started investing in 2018, started in residential real estate, very quickly realized that I wasn't achieving the financial independence or moving towards financial independence as fast as I thought I would. And the goal was to always graduate into commercial real estate with a focus on multifamily. So I decided to take the leap late 2019, early 2020. I worked at a small boutique private equity firm here in Houston, Texas before, as the Director of Investor Relations before joining Sid and Anam over here at Headway Capital earlier this year. And I'm excited to continue to share my passion, my knowledge, and my education with all of our investing partners. Sid, you want to introduce yourself here?
Absolutely. Thanks, Brian. Great introduction. My name is Sid Shamim. I am the founder and CEO for the company Headway Capital, Headway Investments. My wife, Dr. Anam Amar, she's a practicing physician. She's a gastroenterologist, worked for a national hospital here in Texas. Like Brian said, my background, I'm an IT professional, so I was a computer programmer, a computer science degree, as per you say, when I graduated a long time ago. I did my master's in the same field. I did my engineering work, and whole behold, I was investing, and I realized about 10 years ago, I can go full-time into it. But again, this is not for everybody to go into full-time, but in today's webinar, we're going to talk about how I embarked on my journey. What are the things that I did? Even me and Brian and Anam, we came up when we built this company. We had a clear mindset of preserving our own capital because we were busy. We didn't have time to go out and do operate real estate on our own. So we exactly know what a busy professional life looks like, right? So that's why we built this company. And even today, we are the biggest investor in all of our deals and offerings. So again, this mentality has not changed. But again, that's what we do at Headway, and that's who we are.
Awesome. Thanks for sharing, Sid. A little bit about our track record over at Headway. As mentioned, we've been investing in real estate since 2011. Headway was started in 2017. We have a little bit over $500 million of assets under management, which equates to a little over 3,000 units. And just to give you some context and the types of returns we like to look for to provide our investors is we do look to aim for a 7 to 10% preferred return, which is just cash flow. It's a fancy way of saying cash flow. We want to provide cash flow to our investors in that range. And then overall average annualized return, once you add up the cash flow plus the equity you get when we exit these deals, we look to have 25%. It's kind of our baseline. We like to get as close to 30 as we can, but we like to underpromise and overdeliver. So you see here, it says 20 to 25%. Now, our secret sauce, something I just want to touch on real quick before we jump into the IT professional topic. This is something that we're really passionate about. We're really passionate about making sure investors understand what makes us different, than the other private equity firms out there. And this is the recipe. This is our recipe for success. And it's being focused, it's being purposeful, it's doing discipline work, not just working to work, but making sure we're staying disciplined. And we're doing it consistently over a long period of time. We believe this is how you produce results. So this is our secret sauce. We stay super focused on what we're trying to accomplish, and our number one goal, and we say this all the time internally, to really focus on growing and protecting your wealth first. Our rule is we never lose investor money. So we're really focused on that. We're purposeful in the work that we do and the projects we choose to proceed. We look at dozens and dozens of deals a month in different asset classes, particularly multifamily, car washes, different investment opportunities. We're not going to present all those to our investors or choose to pursue those because they don't align with our vision. They don't align with our mission and what we're trying to accomplish with you. And all the work that we do is disciplined, and we're consistent over a long period of time. We are here for the long haul. And we know this is going to produce long-term results because this formula has worked for us already since inception for over 5 years now. All right. Let's jump into the IT professional topics, which is really important. But before we jump into the specifics of that, let's talk about the importance of passive income. Sid, you want to talk a little bit about the things you see here on the screen and why you think passive income is important for IT professionals?
Absolutely. And Brian, if I can, I would like to go back on the previous slide, and I just want to make a comment, right? So this is not the most attractive slide in the whole presentation, right? But this is the one most important thing that differentiate us from any other investment groups out there, right? So we are not financial advisors. We are not somebody who will advise you and get paid for the advice only. We only get paid when our investment performs, right? So that's our internal model within our company. We have, in totality, we have about over 200 employees, out of which right under 100 employees are right under our control. And then this secret sauce has been inbuilt, engraved, and being enforced to each and every one of our team members, of our employees, right? Whenever we pick anything, we are very, very, I call it laser focused on what we're picking. We are always purposeful, and we just not believe in hard work, but we also believe in disciplined hard work, right? And being without discipline, without being hard work, there's just no results, right? So this secret sauce is just not a single slide on this presentation, but it's more it's a reflection on Headway, who we are and how we think we're going to succeed, and we have been succeeding on our track record, right? Some days are great, some days are not so great. We don't ever claim that we will always perform on every single thing that we're going to do, but we will make it damn sure that we're going to do and give 100% of everything we got to make everything work. And that's really our secret sauce so far. That's why you see the track record of $500 million of assets under management, the returns that we're targeting, and the projects that we pick. So that's, I'm kind of passionate about the slide. So anytime when Brian takes it up, and I try to go back and make my voice heard over there.
Awesome.
So being a passive investor, right? So And we're seeing some questions coming in. Michael and a few other questions. We'll get to it at the end of the presentation. So thanks for your patience. Give us another 20 minutes and we'll be wrapping up pretty fast. So my background is like I said, I'm a computer science graduate. My first programming language was assembly language, if you can believe it or not. And I did my Pascal, and then I did my C++ and my C#, and then the Java, and then all of that new platform. So when I started, all I wanted to do is I wanted to be a computer programmer, and I wanted to work for certain companies. One of them was Microsoft. And I did awesome in that, right? But with my master's, I had a 4.0 GPA. I graduated right in 2008 when nobody was hiring, and I still was able to manage the job. And everything was going fine until 2012 comes in, right? 2011 comes in, really, where I realized that no matter what I do, I'm trading my time for money, right? I cannot make it for the amount of time that I have. I cannot multiply it, right? So that was the first light bulb. That's like, hey man, I'm working so hard. I'm so talented. I did all of these great things, and I've been working. At that time, I was working for the biggest oil companies that you have heard of. But then my growth was just capped on whatever I earn on my W-2. So that was the first light bulb. The second was, I was not financially independent. So if I had to buy something or spend on my education or spend on certain thing that I want in my life, I'm giving 2 to 3 times serious thought about it, right? So, and I'm not the only one. A lot of people are like that, right? They make good money, but they're also not financially independent. Now, even if you're making good 6-figure, which I was making at the time, a really healthy 6-figure, but I was still, managing my budget, which is the right thing to do. But I was not financially independent to do things the way I wanted, when I wanted, how I wanted, right? That was just not there. And then the last thing, which was, which, I mean, people who have seen 2008, 2009, you guys know what I'm talking about. We came out of that 2008 downturn, and people who were trying to retire at that time, that was the first realization for me that in 2009, 10, 11, 12, especially in 2008, 9, and 10, people were not able to retire because there was no money in 401. So imagine you're a 65-year-old, or you're trying to retire, you're 70-year-old or 75-year-old. My boss was 75-year-old, and he was trying to retire. He couldn't retire. He went back to work. He had a plan to marrying his daughter. He had a plan to start being regular with his grandkids' baseball games. And I know him because I saw this real example. He could not retire because there was no money left in the 401k. The market was crashed. That was the third realization. I was like, man, I don't want to do this with my life, right? So I was an IT engineer. I didn't have any background in commercial real estate or any of that. But at that time, at that year, in 2010 and 11 time, I decided I'm going to start buying real estate, right? Again, you learn from your mistakes, and then you make a little bit better decision, but there are still mistakes, right? So on the next slide, we're going to talk about what I did to grow my potential, to reduce the risk. I'll talk about what enforced me from this one source of income, and why should I go into the multiple source of income, or more than one source of income. Could be passive, could be active. I can be active because I'm working full time. So there was no other way for me but to become passive in the other activity, right? So let's just talk about, if you are a W-2 IT professional, right? You have 2 biggest advantages. Number one, you can carve your time out to do your own research because you're an IT professional. You are on average a better person suited for researching any investment property compared to a physician. My wife is a physician and she works all the time. She has no time to even think about and look into the research. However, but since we were married and I've been educating her, she's now super good at advising people on her own domain, which is her medical doctors. But when you come to IT or any engineering firm, any engineering professional, or any professional who are working mostly on computer, have an added advantage or an edge compared to other professionals, that you can do more research and make better decisions faster than other people, right? If you are somebody working in an oil field, standing on a rig, you have no time to go to the computer. You have no time to spend on computer. So let's talk about how you can go. First, let's realize what is the risk we are going into when you stick with one source of income. I'll tell my experience. When I realized that people were not able to retire in time, the limit is the growth is limited, and no matter what I do, my annual increment won't be more than 20%. And I'm telling you, 20% is a very high number. Brian is giving me different looks, but 20% is a very high number on the annual growth of anybody's salary, right? I immediately decided that I need to offset my active income from my passive income. Why? Because of these 4 reasons that you see on the screen. Your growth is limited. You have no financial flexibility. Your retirement is not adequate. And then your personal time, you cannot buy back your time, right? So if you're not working, you're not getting paid. You get 4 weeks of vacation, maybe 5 weeks of vacation. That's what I was getting at the very end of my career, right? And that's a very generous vacation package. I don't know anybody who gets more than 2 weeks. In my company, we don't give more than 2 weeks because that's the nature of our job. I was lucky enough, but I worked 10 years for that, right? Or 12 years for that to get to that point. Going back, how do you remove your one source of income to multiple source of income? And I give the form, when I talk to people, I tell them a formula of like, start offsetting your income, right? Try to go from 0% of your passive income to maybe 50%. Or 60%. And until you get to that point, don't try to buy another job for yourself, right? A lot of people I've seen, and I did the same mistake, probably Brian did the same mistake as well, is that we start going and we buying single family houses. Realize it or not, it sounds really sexy, but it's a full-time job. You're collecting the rents, you're doing the repairs, you're making sure that the tax has been paid, property insurance being paid, everything is in line, and you're taking the liability, right? So I did the same thing. I went in deep, and I bought over 30 houses at one time. That was the time when I realized, man, I cannot manage any of that. Now, remember, I was working full time and I was doing this to offset my income. It was a good idea for somebody who I was doing only 2 things at that time in my life: work and buying houses and managing houses. I was not spending time in none of that, right? Now let's talk about, when you do that, how do you burn out, right? Let's say, for example, you're just W-2, you're not doing anything on the side, which means you're not working, then you're not getting paid. We have talked about all of that. Let's say you do something, which you start buying houses, you're essentially buying yourself a new job. I was lucky because I had time, and I was single, no kids, none of that. These are the only 2 things I was doing. So when you rely on your one income, you really don't have a passive income, and the inevitable happens, which is when you burn out. When you burn out, you start detesting your job, you start detesting your boss, you start detesting pretty much anybody and everybody that comes into that, right? You don't like going to job. I mean, even after COVID, we've seen the most number of people not really liking it, but they have no other option because they don't have any other passive income. So, the offset formula is to go find passive stream of income. Passive, where you're not spending any time. You're doing your research, and that's it. And you offset your active income by at least 60%. So let's say if you're making 100K a year or 200K a year, for 100K, you have to make passive income at least 60K a year before you can start thinking that you can go on your own and pick your own time. That is where the next slide comes in, right? So if you can achieve that, what you're really achieving is you're buying your time back. So at that point, you don't have to work full time. You can work 20 hours a week, 30 hours a week, 10 hours a week, because 60% of your income is coming from somewhere else. It's not depending on your job, right? So that's what I did. Everything that I said in this presentation so far is exactly how I did it, right? I realized the problem. I started creating another set of passive income. I started buying houses, which was somewhat of a mistake. If I go back, I would not do it. But then right after that, I started investing with other people for bigger projects. And I realized that I can do it on my own. And that's when I decided to quit my job and then start purchasing bigger commercial assets 8 years ago. But when my first commercial asset that I bought, I could have done it long time, way earlier, but I spent another like 3 to 5 years in between just managing single family houses, which in my opinion was a big time draining activity that I had at a time. So, that's my little story. The goal again is, of course, do not kill the only W-2 that you have. Don't think that you can go out and be a Donald Trump real estate rock star, right? Realize that your one source of income is everything you've got. It's going to take you. We have so many IT investors from California, even from Texas, and they understand that they have to create this snowball impact. Invest, you maybe get your returns, sell something, reinvest, get your returns, sell something, reinvest, sell, get your returns. And in short few years, you will realize that you have this investment coming that you may not even have to work full time anymore. I mean, of course, if I was a good programmer, I love programming. I still, it's hard for me to not to go into too much technicality, which Brian don't like when I do that. But again, if you love your job, you do your job on your own terms, and you can only do it when you have your passive income that is offsetting your W-2 income, right? And I'm pretty sure anybody that I talk to, they all want to think about it, but they just don't know how to start. And it takes one deal, it takes one investment to start with, right? So start somewhere. Like a lot of seasoned investors say, stop speculating, start investing, right? So with that, I think I'll give it back to Brian, and let's see what he got.
Yeah, no, Sid, you did a great job laying the foundation there and setting the tone for why passive income is so important for IT professionals. One of the things that Sid failed to mention that was important for me to highlight is a lot of IT professionals and people in that space, they're very high income earners, right? You're making a very healthy living. Most of the time you're making in the low mid six figures, $150,000, $200,000, $300,000, if not more, depending on where you live, where you work, obviously how long you've been there, which puts you at a very high risk. We've seen headlines this year about all these professionals getting laid off at all these IT companies, the Googles, the Apples, the Twitters, right? It's not uncommon that when we go through a recession, they start laying people off, and highly paid professionals, for example, such as IT professionals, they have some risk exposure because of their high income earner. And you don't want to get caught in a situation where you have no supplemental income coming in, no passive income coming in from some types of investments, whether it's your equities portfolio, your stocks, whether you own a small business, whether you're a passive investor in real estate deals. You don't want to get caught in a situation where you go from making $200,000 a year to zero because the market is in the toilet, right? So it's very important that you build these passive stream of incomes. And to Sid's point, before we move on to the next slide on how you do that, it's a one at a time type investment. This is a 5, 10, 15-year horizon, which is why there's a saying the best time to invest in real estate was yesterday. Not all deals are going to be home runs, right? And if you're going into real estate and you expect all deals to be home runs, and you're going to go from, investing $100,000 to making $10 million, well, that's not how it works. You have to keep investing. You have to keep reinvesting. Sometimes you might have some duds in there where you just break even, or maybe you only make a little bit of money, right? But the goal is to, of course, not lose money, but you have to keep investing. And just like with your equities portfolio, where you take risks, whether you're a VC investor and you like to invest in venture capital, or you like to invest using your portfolio of your equities market, you just got to keep investing. It's the old dollar cost averaging method, where if you make enough investments over a long period of time, eventually it starts to snowball, and your average cost of that equity looks very attractive on paper, and you have a ton of equity, a ton of wealth built over a long period of time. So the key there is just get started. So how do you just get started? How do you do that, right? What are the passive real estate options for somebody who's in the IT professional? So I'm going to go through these, not super detailed, We're going to go through each one of these and see what the difference is in case you don't know what these are. So the first one here, you'll see on the top left side is a real estate debt fund. So what is a fund? What is a debt fund? We'll talk a little bit more about that in a couple of slides. Headway actually has a debt fund, but a debt fund is essentially a fund that you as an investor can invest into that will give you cash flow distributions, usually monthly. Sometimes it might be quarterly. It depends on where you invest, who you invest with, but essentially you're making loans into a very large pool, very large fund that is then taking that capital that the investors loan into and they're distributing it, they're loaning it out to other people. So for example, let's say I flip houses and I do that full time. I'm a house flipper. I find really cheap houses, I make them super nice and I sell them and I make a bunch of money. Well, it's very uncommon that I use my own money. Some of the most successful flippers, they don't use any of their money. Well, where do they get their money from? Most of the time they're using hard money or they're using private funds. And the hard money side of things is where the real estate debt fund comes into. They're borrowing money from these debt funds at a high interest rate. They're typically 12 to 13% or more. They're going in there, taking that cash, they're flipping the house, making it nice and pretty, and then they're selling it for a profit and they're repaying the loan that they borrowed from the debt fund. So the debt fund is the source of capital for these investors. And we pay our investors, in most funds that do this, a split of the distributions, right? So the investor borrows at 12%, and then, there's an arbitrage in between there, and we're able to provide our investors with a steady stream of income over a long period of time. So you might get 6%, you might get 8%, it just really depends on what you invest. But that's a debt fund. Those are very popular vehicles. And the cool thing about them is they provide liquidity because they're not 1 year, 3 year, 5 year long-term projects. Most debt funds have a much shorter timeline compared to multifamily. So multifamily, for example, would be 5 years. A debt fund could be as little as 90 days or maybe as much as 2 years. It really depends on the company you're working for. So that's the real estate debt fund. The other one to the right, you'll see private real estate offerings. So those are going to be something that we really specialize in too as well. Those are going to be your passive investment opportunities in a private placement offering where we go out, or a firm like ours goes out, they find a project, they find a multifamily deal, they find a condo community, they find an industrial deal, they find a mobile home park, they find a car wash portfolio. There's so many different asset classes in real estate. But it's a deal by deal basis. It's not a fund. It's not always open. It's when we go out, we find these amazing opportunities. We want to present them to our investor. It's a private offering, and you only get to see it if you have a relationship with us and if you are on our private investors list. You've invested with us before, essentially, or you've expressed interest in investing with us. Very different than a fund, because a fund is very often open for longer periods of time, and a fund usually invests in multiple projects as well, provides a little bit of diversification amongst the assets. You're not just investing in one single family house or one single family flip. The fund is investing in multiple, so it gets some diversification. The private real estate offering is a single project. So if you like to drive by the project, you like to touch the building, you like to see the exact deal that you're investing in, what market, how many units, how much are you paying for it, what's the cash flow, the private real estate offering is the bucket you want to be in. So these are typically longer term holds. They're 3 to 5 years on the low side. And they're long-term commitments. So once you invest, it's not like the fund where you can pull your capital out. The other two options you might be a little bit more familiar with, the real estate investment trust, that's a REIT. That is more like an equity. I would say behaves more like an equity. It's more like a stock. You can usually find these on the same platforms you're doing your equities trading with, or your financial advisor can help advise you investing in a REIT. But a REIT is a lot different than the real estate itself. You are investing in a company that buys real estate. You're not directly investing in the deal. You're not directly investing in a particular offering. So because of that, you don't get the same benefits. Now, the company may be very profitable and you still might be able to get dividends or distributions from a REIT, depending on if it's monthly or quarterly, whatever REIT you decide to invest in. But it's not a direct investment in real estate. So it's going to have a limited type of benefits. So you're not going to get depreciation. So you're not going to get the tax savings or tax benefits that come along with a private real estate offering. You're also not directly investing in a particular asset. So you're trusting the REIT to make the decision for you on what type of assets you're investing in. And then the big part that I want to make sure I highlight is the lack of a relationship. You're not going to have a relationship with a REIT. You're not going to be able to pick up the REIT, call the guy and say, hey, what are you guys looking at? What are you investing in? Tell me about the business plan. You're just a number, just like a stock investor, right? So with a private real estate offering or real estate debt fund, you're going to be talking to the firm that is placing the capital, right? You're going to be able to have a relationship with somebody on their team to build a long-term relationship so you can continue to invest with them. So there's a relationship piece there that I think is very, very important. And then the last one you might be really familiar with, our crowdfunding. And these are online platforms that essentially pool capital from investors, usually accredited investors, which means you have a $200,000 a year income or 300 if you're married for the last 2 out of the last 3 years, or you have at least a $1 million net worth. They're going to pull investments from accredited investors, and they're going to go place them in projects as well. But just like the REIT, there's going to be a lack of a relationship. This is strictly an online platform. You log in, you've got a username, a password, you look at the deal, you decide whether you want to invest or not. And that's about as far as it goes. So again, a lot different. We really value relationships in our industry, whether you're investing with Headway or investing with somebody who does what we do as a competitor. The relationship piece is really important because we like to say you're betting on the jockey, not the horse itself. So we think it's really, really important you get to know the jockey. And in this case, it's Sid. Any comments on these options here?
No, absolutely. I think you covered pretty much everything. Nothing to add except one point I would say, like you said, on the crowdfunding in the REIT, you have a login password and you're investing from a portal. You have no control on understanding how the operations are working. You have no control on understanding how the business is going to perform. And like you said, like Brian said, you have nobody to talk to say, hey, look, was the expectation, and we are doing better than expectations or lower than expectations, or what are you guys doing better, or what are you guys planning on doing to make it better, right? So there's nobody to talk to. That's why the private investments are very, very famous, because as an investor, you directly talk to one of the team members, either Brian or myself, or our investor services, right? So you get the direct answers on exactly what's happening on any of your investment, right? So it's entirely different than just a crowdfunding. I mean, a crowdfunding, as the name says, is a crowdfunding, right? You don't get personalized attention, and you don't even most of the time knows where your money is really going, right? The REIT is the same way. You might go and invest in Google, but Google is a tech stock, right? And Google perform as a whole, then you get the dividends. If not, then in most cases you don't, right? That's what happened with me in 2015. Like Brian mentioned, right? When you're not working, you're not making money. But not working means it could be, you lose your job, or you decide not to work, or God forbid some life event happens, right? Which almost happened to me in 2015 and 2014 time when the oil was down, right? That was a time when the pricing of the oil pricing was down, and majority of the oil and gas companies started laying off. It's happening right now as well. I've heard some big companies, they're laying off. Out of these four ways, you can, start hedging yourself, start protecting yourself. We personally, 98% of my net worth has been invested into real estate, and 0 is in REIT, 0 is in crowdfunding. It's all in either debt fund or in private investments. Right.
Good to know. So what's the formula here? Once you decide which vehicle's for you, as I mentioned on the previous four, how do you do this? This maybe makes it sound easier than it really is, but the goal, step one for you as a IT professional or busy professional, is you have to invest in quality assets. This is really, really, really important, because when investment opportunities are presented to you, you have to understand what's good, what's bad, what's a quality opportunity, and what's not a quality opportunity. Because if you don't know what your investing thesis is, you don't know what your investing goals are as an investor, you're not going to be able to tell if it's the right deal for you. Now, I will mention, not every deal is for every investor. Like, let me say that again. Not every deal is for every investor. That doesn't mean it's a bad deal. It just might not be for you. So I'm going to give you an example. Let's say I am a cash flow investor and I really like cash flow. And part of the reason I'm a cash flow investor is because I'm 60 years old and I'm approaching retirement. And I really want to improve my cash flow these next 5 years or these next 10 years that I have left in my career, so that when I retire, I don't only have my 401k or whatever type of equities investment that I've invested in. I want exposure to different buckets. I want 20 or 30% of my passive income, or my income that I'm living off of, to come from real estate. 20 to 30%. It's a really healthy number, right? You don't have all your eggs in one basket necessarily. Well, I need to invest in deals that are cash flowing. So not every deal cash flows, which sounds crazy to think of, but there's so many different investment vehicles. Some might not cash flow. I'll give you an example. If you were to invest in a new construction project, let's say you get an email in your inbox and there's this new apartment complex or this new retail strip center that's being built and it looks amazing. You're going to get a 25% return. You're going to get this, you're going to get that. But guess what? Those deals don't cash flow. Why don't they cash flow? Because there's no existing building yet. They take your money and then they're going to lock it up for anywhere from 18 months to 3 years, usually 2 to 3 years on average. And then when the property is finally constructed and then it sells, that's when you get paid, right? You get a big lump sum. There's no monthly cash flow. There's no monthly distributions. There's no dividends, right? Same thing if you were to invest in a land deal. If I come to you and say, hey, I've got this great land deal, we're going to go buy this piece of land. We're going to hold it for 3 years and then we're going to flip it, right? Well, that sounds really cool. Sounds really sexy, but guess what? No cash flow. Land doesn't have cash flow unless there's a building on top of it. There's somebody paying rent, right? Compare that to if I'm looking for cash flow, say maybe a multifamily deal or a car wash deal that is showing you that day one, when we acquire the property, there's cash flow. You're getting 6%, you're getting 7%, you're getting 8%, you're getting whatever the number is on the pro forma, and they're projecting that you're able to start getting that cash flow a month after they close, or 60 days after they close, or 90 days, or whatever the project timeline is. Well, that really aligns with my investing thesis because I'm approaching retirement. This project is 5 years, and I'm going to be getting a monthly cash flow for 5 years, right? So I get 60 months of dividends paid to me over the course of 5 years. Of course, the property could sell sooner, but at least projected, I'm going to get 60 months of cash flow. Well, that really aligns with what I'm trying to do. So I can make an investment knowing that I'm going to have some cash flow coming in. And then if that property sells sooner than my retirement, well, guess what? I'm just going to take my lump sum that I get plus the cash flow, and I'm going to reinvest it. I'm going to find another project, either with the same operator or with another operator that I really know, like, and trust. And I'm going to keep building that cash flow. So if I invested $100,000 today, when the property sells, ideally it would be 200,000. Well, I'm not retired yet. So I'm going to take that 200,000 that I now made. I'm going to reinvest the whole thing, right? Because I want that cash flow. It's really, really important for me for retire. So quality assets, knowing your investing thesis, your goal is to grow your passive income over time so that you can be less dependent on your W-2 income and really achieve that lifestyle freedom. Sid, anything you want to throw in there for that formula?
No, but it's all in line what you said. I just wanted to reiterate what we were initially talking about is like to create your offset, right? So you as a professional, you know your monthly expenses. If the way I did that, the way I used my formula, I first looked into what is my monthly expense that I have to cover if my job goes away, right? And that's a reality. It's a sad reality, but it happens to most people. So find out that number, find out what is that percentage offset of your W-2 income, right? And then, like Brian said, keep finding those quality assets or quality operators or both, ideally in case where you have, you know, the operator, the company, you know, the product, the asset, and then you have a relationship with them where you're investing with them. That is the most sophisticated way of, or a good way of doing it, right? Once you, again, it takes multiple cycles, multiple investments to make that snowball impact, right? 1 deal to 2 deals to 3 deals. And all of a sudden, all you know that most of your income is coming from passive incomes, right? So at that point, you pretty much can buy your time back. So that's Brian.
Yeah, the thing I want to make sure I highlight that Sid just said is probably if you're taking notes or you're thinking about this whole thing, it's probably the golden nugget. It's the one thing, if you're going to take anything away, that's really important, is you have to recycle your capital. So we talk about recycling capital and the velocity of capital all the time internally. That's a really, really important note. Just think about a model, right? It's the model that was always explained to me was it's like a treadmill or like a conveyor belt, right? So if you invest in 1 to 2 deals every year for 5 years in a row, you have 10 deals on the conveyor belt. So think about a conveyor belt, you've got 10 deals on them, right? After 5 years, 1 deal falls off the conveyor belt. That's the property that's sold. Well, that $100,000 investment you made is now $200,000 ideally, right? So you take that and you put it back on the beginning of the conveyor belt. Well, now it's not a $100,000 investment, it's a $200,000 investment. Well, guess what? That next year, another one falls off the conveyor belt. What do you do with that $100,000 investment that is now ideally $200,000? You put it back on the conveyor belt. Now you have 2 deals on the conveyor belt that are $200,000 invested, not 100, because you ideally doubled your money on those 5-year holds. And you keep recycling the money on the conveyor belt over a long period of time. And after a 10-year window, you will have had multiple exits on multiple deals on $50,000 to $100,000 investment. That's where you really start to create this generational wealth just from being a passive investor. You're not even being an active investor. But the thing that messes most people up is they don't look at it on a long time horizon. I'm talking 10 years here. I'm talking 5 years on the low side. So you have to really start investing in these projects as soon as you can if you're going to start to build that velocity of capital and get that conveyor belt going. Really, really, really important.
Absolutely.
So
Yeah.
last thing I just want to kind of wrap up here. We're ending on near of our time. We'll talk about some opportunities we have here at Headway. Passive investment opportunities with us. So what we focus on is we really love multifamily. We do have a private management company that we own, Headway Properties. We manage all of our Houston-based assets here on our own. We've got over 50 employees working for us, managing these assets, working their butts off day to day to make sure that we provide returns to our investors and protect their capital. We also own real estate service businesses, which is important for us to try to make sure we're able to really multiply our investors' capital. So if we can buy real estate businesses and layer them onto Headway Properties and the Headway Capital, that's going to give us economies of scale and efficiencies with costs when we do go out and buy projects. We also have our real estate debt fund, which I alluded to a few minutes ago, which I'll talk a little bit about here in a second. And then the last one is car washes, which is something we're very passionate about as well, because they are great cash flowing vehicles. So just to touch base on that in particular, those two offerings, we do have a car wash opportunity that is nearing the end of funding. We've got probably about 9 or 10 days left for this one. We're going to be looking to wrap this one up on Friday, July 28th. It's a portfolio of 8 car washes. It is for accredited investors only. The minimum investment is $100,000. So if you want to invest in this deal, you want more info on this deal, scan the QR code. If you don't have the QR code, you're not able, maybe you're watching this on your phone, send us a message, reply to the thank you email that you get, or just go to our website and if you go to the current offering section, you'll be able to find it there as well. Happy to schedule a call, happy to send you any material you might be interested in. This is a great opportunity. It does pay 6% cash on cash year 1, ramping all the way up to 10% by year 4 and 5. It does have a 9% average cash on cash return, and it does have a 10% true preferred return, which means that we don't take anything, we don't make any money until our investors get 10%. A really great opportunity in the Carolinas and in Alabama for you to get into some cash flowing car washes to diversify your portfolio. Secondly, we do have a debt fund that is launching here pretty soon. You should see some formal communication in your inbox about this here in the coming weeks. But as I mentioned, this is a hard money debt fund that provides capital to fixers and flippers. But we need investing partners to make sure that this thing grows. And this is a great opportunity for you to put any extra cash you have sitting in the bank to work. It is a 506c offering for accredited investors, but it has a $25,000 min. So if you invest anything less than $100,000, so $25,000 to $99,999. The return is 6%, and that is paid monthly. If you invest anything $100,000 and up, it is an 8% preferred return. And we do have some investors that are interested that we've spoken to that are in our fund that have placed a 7-figure. So if you're looking to place $1 million or more of capital, let's take that conversation offline. We can talk about the dividend payments for those types of investors as well. This is a great option because it does have a 90-day liquidity option. So if you want to put $100,000, $150,000, $200,000 in the fund, leave it in there for 6 months or a year and pull your cash out, you can always just give us an email and we will promise to get your capital back in 90 days or less. I will tell you on average, you usually get your money back in 45 to 60 days. We try to move as fast as we can, but it's a great option. It does not offer the same benefits as a private investment. It doesn't have the tax benefits, but it does have the monthly distributions and it doesn't have the equity upside. Again, just another alternative to investing in, say, like a CD or anything else, paying a slightly lower fund if you're looking to beat inflation. Sid, any comments on these last two things before we take questions?
No, just the last thing. So I think the debt fund is one of the very rare fund that I've noticed have a huge interest from our partners. And that's why we're doing this webinar to communicate it properly to everybody that we know. The 25 is the minimum, but the most optimum investment that I've seen so far that people have done so far. I personally have invested significantly in that debt fund myself. For every 100,000, you get 8% return. It's a 90-day liquidity, so it's very effective for anyone who don't want to invest in long term or don't want to hook for long term commitment. But car wash is long term commitment, but you have an upside with that, right? We buy, we operate, you get the cash flow while we're operating, and when we sell, you get the upside at this time of selling. and that is a great thing, right? When if you want to take that kind of you have that kind of time. But debt fund is 90-day notice, you can get your money back, right? That's way better than any CD that I've seen. None of the CD that I've seen is giving more than 5.1 is the max that I've heard that CDs are giving, but they want 6 figures and they want to lock your money for a year, right? Not for debt fund. Debt fund, you pay 100, you invest 100K, you get 8% annualized return payout monthly after 6 weeks of holding time, but it's a monthly distribution, and you can, if you want your money back, you can give us a 90-day notice and take it back, right? So that's a beautiful.
Yeah, and it's a cool because it does have a compounding option. I don't want to get too much details. This isn't about the debt fund. It does have a compounding option. So if you want to put your money in and not take the distributions, you can leave them in and let them ride, as I like to describe. So that's a really attractive option as well. So if you have any questions, scan the QR code. There's a soft commit there. If you submit the soft commit, we'll get more info over to you. And again, just keep an eye on your inbox. We'll be talking a lot more about the debt fund here in the coming weeks. We're very excited about it. So let's open it up to Q&A. Sid, you want to lead the Q&A? I know there's several questions we received via email before, and then we've got some questions coming into the chat box here. I'll go ahead and open up, but Sid, you want to take the lead?
Yeah, so the first question is, as a non-real estate, I think there are 8 questions so far, but I think the very first question is, as a non-real estate professional, what are the tax implications? My understanding is we typically can take depreciation. I can take this answer, Brian, if you want.
Yeah, go ahead.
Yeah, so if you're not a real estate professional, you will pay regular tax, but there are IRS codes allowed. So contact your CPA, right? There are IRS codes that allows you, if you do certain things or qualify for a certain way, then you do or you can take the depreciation, right? For example, my wife, she's a physician, and she don't pay any income tax, right? Because I take a full depreciation and make it effective on our W-2 income. However, there are other ways as well. So contact your CPA. The short answer is yes, there are ways, but in most cases, if you're both working, it's not the case. So when we invest, I don't take depreciation as my key to investment. My goal is to, again, Brian's example, right? Conveyor belt, a snowball impact. You invest, keep investing, in a few years, you pretty much get the whole, it becomes bigger than you can think of. I can tell you this much. Second question, Brian, how can one start in debt fund?
Oh, great question. So first thing, to kind of piggyback on the depreciation question, there are tax benefits to investing in both in a private long-term investment, such as a car wash or multifamily deal. I will say we're not CPAs. Everybody's situation is different. You need to talk to your CPA about that particular situation that you're in, but I'll speak very broadly and very generally. Every year when you invest in one of these long-term projects, if it's the right project, such as a car wash or multifamily or anything that's long-term, you're going to get depreciation every year at the end of the deal. The sponsor or your partner that you're working with is going to provide you what's called a K-1. It's a tax document. You provide it to your tax professional, your CPA, and they're going to be able to essentially use the depreciation to show losses on the passive income that you earned. The trick or the misunderstanding that some people get is they think that they can take that depreciation, which is negative loss that you will show year one for that accelerated depreciation that we're going to take, and they think they can apply it to their active income. The active income is your W-2 job. That is almost certainly not the case. I've never seen that. Again, I'm not a CPA. This is not advice, but generally speaking, you cannot take your passive income losses on your K-1 and apply them to your W-2 active income, right? Yeah. That is not the case, but you can take those losses and apply them to your passive income. So let's just say you have a deal where you get a 7% return year one, you invest $100,000. Well, that's $7,000 of cash flow you're going to get on an annual basis, right?
Yeah, and that's tax free. Yeah,
and that will be tax deferred is the word I like to use. It's not tax free, as if you never pay the taxes on it, because you will pay some sort of tax on it when the life cycle of the deal sells. Typically, if there's not depreciation left to carry over and you don't have other depreciation from other deals to offset it, but it's tax deferred, meaning that year that you're getting that cash flow and years after that, you get to kick the can down the road on the taxes you pay. And that is also why it's really, really important, in my opinion, that you keep investing in other deals. It's a mistake to invest in one deal and then wait 5 years, because eventually you run out of depreciation and you're going to start to pay taxes on the income that you're getting. Well, if you go invest in another deal passively, you can take the depreciation, the passive losses from that second deal, and you can actually use some of them on the first deal if you run out of depreciation, right? So it's all one bucket. It's the passive income bucket, and you get passive losses that all can apply to each other. They just can't apply to active income. So hopefully that clarifies it a little bit. It's important to, again, talk to your tax professional, ask the sponsor about the depreciation. Our car washes typically see 60 to 70% depreciation, so negative losses year one through accelerated depreciation. Multifamily is very similar. You're going to see 70 to 80% year one. So, but to answer the original question, Sid, about how can you get started in a debt fund? If you're interested,
how can one start in debt fund? Go ahead.
Yeah, how can one start in a debt fund? So there was a soft reserve form that I had on the screen here a couple minutes ago. Scan that QR code, or if you go to our website and you apply to invest, there's a button there that says apply to invest, and you fill out the form. It's going to let me know that you're interested in investing with us. Somebody, for either myself, somebody from our team will reach out to you to open up a conversation about which opportunity you're interested in, and then we'll see if we can get you started. At what investment makes sense for you. Is the $25,000 minimum? Is it 100? Is it more? But the step one is to go to our website. You see here at the top top right-hand corner is a button that says apply to invest. If you click on current offering, that's going to take you to the car wash. But if you hit apply to invest, it's going to have a soft commit form. It's just going to let us know you're interested in investing. And then we can, I will get an email and I'll reach out to you by email, phone, and text, just to make sure you get any info that you need to make a decision if you want to invest in a debt fund.
One more. Well, we have a few more questions, and we only have 7 minutes left. Let's try to get to it as fast as we can. What are the more where are most of your investment? I think that's what it means. Well, we are in Texas, we are in Arizona, and we are expanding our car washes into North Carolina, South Carolina, North Carolina, Alabama. So Midwest and East Coast. Hope that answers the question. What are the short-term investments options available with you guys? Well, debt fund is one of them, right? We call it short-term because there's no long-term commitment. Ideally you should be materializing your investment for at least 1, 2, 3, 4 years. But if you want your money back, you can give us 90-day notice and you get your money back, or get your original investment back, plus whatever you have earned on that income, right? Other question: what are the other opportunities we can invest in? So, like Brian said, I think these are some repetitive questions, but you can within Headway, we are very heavy on apartments. Our biggest portfolio is apartment. We are very aggressive and excited about debt fund and car washes. If you go to our website, apply to invest or current offering, if you don't understand what's happening on the website, or you can't understand, what you want to do, so then apply to invest. It's the button that you want to click, get your information in. Brian or myself or one of our associates will get in touch with you. Last question. I think that one other question came in from.
Yeah.
Go ahead.
I was going to say, as a house flipper, can I borrow money from the debt funds? That's a good question. Yes, we're happy to let you borrow some money if you're a house flipper. Reach out to us, send me an email, brian@headwaycapital.us, or go to our website and hit the contact us form. There's a little box you can fill out there. Just let us know you're interested in borrowing money from the debt fund and getting terms on that loan. And we'll connect you to our operating team that vets all of our borrowers to make sure they're qualified to actually borrow the capital. But yes, please reach out to us.
One other question here is, what other do you guys have? Well, this is a repeat question again, but somebody's asking, do you guys have an active open opportunities? That's what I think what he means. So yes, we have a car wash in debt fund. I think our debt fund is going to close. We're doing into cycles, so it's a long-term option, but it's a long-term. It's a long window to be open, but we are doing it in cycles. So every month we open limited spots for debt fund, and then we close, and then we decide how much more we want next month. So every month is unique. If you're interested, I would say set up a call or give you information, and we'll go from there.
Yep. Got another question. Try to wrap this up real quick. What are the debt terms of the car wash? I'm happy to share that with you. If you want more information on the debt terms of the car wash, or just the car washes in general, send me an email. I have our offering memorandum that we show all of our investor that has details on the debt and the capital stack and how it's put together. I will just speak from the hip here off the top of my head. I don't have it in front of me, but it's in the low 60s on the LTV side. So we're not over leveraging the deals. It is floating rate debt, but there are interest rate caps that were perched at the time of acquisition. So we'll make sure that the debt terms don't get out of hand. The deals are underwritten at the floating rate debt cap. They're not underwritten at what today's market is. They're underwritten at what it could be if we hit that interest rate cap. But again, if you have particular questions about the capital stack or the debt terms, just reach out to me. I'm happy to share our investor memorandum so you can see details of that. But it is all in there in the deck. But great question.
I think that's all we have, Brian. I think we're a little bit early, 3 minutes early. So how about we wrap up?
Yeah. I don't see any last minute questions coming in. If you have any, please feel free to chime in. If not, we are excited about the opportunity to come to you weekly. We'll be here again next week,